you have been lied about how the money is actually created in a corner. You may think that who am I to discuss about this matter and going to tell you about the economics and the central banking. But yeah, I have gone to a research paper which is actually issued by the Bank of England, and this tells about everything how the fraud money is actually created in the economy. And it's just a total opposite of what you learn on the YouTube and the typical economic textbooks. So you may know about the fractional reserve banking system, and if you don't know, then this system actually works like this. The first, if you have some money, you're going to deposit that money into a bank. And what the bank is going to do, according to the regulations of the time, is some considered reserve ratio, which is being implemented by the governments. Banks have to reserve some amount of the deposits into the lockers, like 10%, 50%, or the 20%, and then the other amount can be lent out to the borrowers or to just invest it somewhere else. So banks actually just, for example, the ratio is the 10%. Bank is just going to put the money, put 10% of that deposit into the lockers, and then just going to lend out to a borrower the rest of the money, the 90% of it. And what the borrower is actually going to do, that the money from the bank and going to deposit that money into its bank account. And now the bank again can, the other bank or the same one, if the bank account of the borrower is in the same bank, is going to reserve the 10% of that deposit and lend out somewhere else to another person, 90% the rest of the amount. And this cycle just gets repeated until the whole 90% of the bracket is going to be lent out, and not even a single penny gets left out. So just like the Johnny Harris case.
This continues to happen over and over and over. My 10 grand just keeps getting used to be lent out, put into another bank, and then lent out again. In fact, if you model this out in a nerdy spreadsheet, which is something I like to do, you'll see that if I deposited $10,000 in the bank, $10,000 is added to the system. But then for each one of these transactions, more and more money gets added to the system. This is the aggregate of all of the money being added to the system. My $10,000 turns into this. Look what happens. Look, just keeps going and going. And eventually, it effectively 10x's. It sort of flatlines out at $100,000. What? My $10,000 just turned into $100,000 into the economy because of weird mental constructs? Yes, that is our modern financial system. It is amazing, and it's kind of mind-blowing.
So this is the actually traditional method which is believed that how the money is actually created. But this is not the right way of the creating money by the banks. Banks just use something really complex. And I'm just going to break down that link into this video. Before this, first you need to understand the broad money and the base money. Broad money is the money created by the commercial banks. The banks apart from the central bank. They actually create loans, they actually deal with the normal people in the economy. And the base money is actually created by the central bank. The notes and coins you have in your pocket is actually created by the central bank. It's called the base money. And actually right now 97% of the whole money supply is broad money, not the base one. You must have to keep this thinking in your mind. So let's beat the myth by and actually find two misconceptions in this method, the fractional reserve banking. The first one is that the fractional reserve banking says some money gets lent out of the deposits. But this actually creates a question in mind that it does not create any additional money in the economy. It just flows the same amount of money in different bank accounts. This is a problematic thing because the loans to deposit ratio actually increase in the economy if the system just works like this. So this is totally illogical to believe. And also this system is inflationary. If this is going to happen again and again, then there's not a stop in the system that would make the banks to stop. And if the central bank increase the reserve ratio to 60%, 70% to keep the banks from lending out money, then that would also not be sustainable for the economy. It will get explained later on by making a broad picture of this thing. To combat this problem, the banks are allowed to actually create the money in the economy electronically against the loans they issue. The banks are just like kind of a magicians who just put out a rabbit out of their hats. But what banks actually do, they put out a loan out of your signature. This will be explained later. Let's go towards the second misconception, the concept of the fractional reserve banking. The second misconception is that the central bank actually implements a monetary policy by increasing or decreasing the reserve ratio requirement. This would increase the reserves in the economy. It would be unprofitable for the banks at the same time if they are going to do that. Instead of this, what central banks actually do is that they put a price on those reserves. They put the interest rates into effect. If banks want the reserves at the moment of urgency, they can just tap the central banking facility and get the reserves at those interest rates. So it puts a price on those reserves. It will be explained later. It is a complex one. Just fold yourself with me. And also in some governments like the United Kingdom and Canada, is the reserve ratio requirement of 0%. So this fact actually defies the full existence of the fractional reserve banking. Here, there's 0% reserve requirements. Bank can lend out freely as much as they want, but this just does not actually happen in the real world. So now let's get on my iPad and just discuss this whole concept. So the first thing here is that we need to understand is there are some loans made by the central bank but also by the commercial banks. These are the accounts of these banks and the consumers in the economy. These are actually the balance sheets. So before making a loan, the commercial bank actually just have assets and liabilities, and they have reserves and currencies in their assets. These are the base money issued by the central bank, the currency, and reserves are what the bank just got for the money out of lending to the normal people. These are the profits, and these are some other reserves held by the other banks into the bank account of another bank. So it's complex, yeah. And on the other hand, their liabilities, the deposits that actually the bank made, the deposit placed by the people in the accounts, and also some the loan deposits they actually create. So this is the whole process. When a bank issues a loan, it just creates a new loan as an asset in on its balance sheet, but at the same time they actually create a new deposits on the liability side. This is actually how the bank actually creates some money electronically. And on the other hand, before making a loan, the consumers, the person who got money from the bank as a loan, they just have some assets, maybe the previous money in the as deposits in the bank account, and the currency, the actually the money in the pocket, and some no money liabilities, whatever it was. And when a person gets that loan approved, it actually gets a new deposit, the money actually created out of thin air by the bank on its liability side, and the liability to pay against that loan. So this is actually the real system works. And on the other hand, this part is actually about the balance sheet of the central bank, and it just have liabilities to pay the against the currency, the reserves. Some people believe that it's just the gold. It is actually pegged against the gold, the money they create, but it is just another kind of a theory. I will break that down in another video. So this is how actually the money gets created in the economy, and the money actually destroyed also when the borrower pays back the loan. The loan just gets simply moved on the balance sheet of the commercial bank. Okay, the only left actual thing is the interest that person paid on that loan. So this whole system actually happens in the economy on the daily basis, on the decision making of the profitability of those loans, not the fractional reserve bank. If making those loans actually profitable for the bank, they would just simply make that. And if that's not, then they're not just going to issue those loans. So how these loans becomes profitable for them and not, if you want to go further, you can just go further. But the whole basic concept is just here. And I'm just going into the complexities of this system now. You may also think that isn't this also inflationary? But yeah, this is inflationary, but the system can actually be controlled in a precise and in kind of a very certain way. The limitation of this broad money creation is that the loan market has direct impact on the money creation. Whether the banks have the available opportunities right now in the market or not, that defines and determines how much the money will be created in the market. We can literally think that banks actually want higher interest rates on the loans. but they also want to give the lowest possible interest rate on the deposits people place with them. So the equation balances out when bank gets the highest spread between the interest rate it gives on deposits and the interest rate they get on the loans they made. Actually, they need to price in the risk of losing more and more reserves. Yeah, losing more and more quantity of base money. Yeah, we can believe that they can create broad money against loans. Yeah, they can issue as much as loans as possible and create as much as money they need, and they can do it as possible. But they actually need to factoring only one specific risk, and which is if there will be more demand for the base money against those loans and deposits. Yeah, they will be downgraded. That's the only nightmare of the banks. Yeah, if they cannot supply the reserves, the base money, the currency, the notes against those loans and deposits they create in the broad money market. So they are actually fearful of the extraction. Yeah, that's how through that a monetary policy works. If they run out of the reserves, they can tap in the reserve facility from the central bank and get the reserves at the implemented interest rates Federal Reserve or the central bank has implemented in the economy at that time. Right now, I can explain you with an example of a mortgage loan. So this is a chart explaining the transaction of mortgage between the house buyer and the house seller and the bank of those person. Yeah. So before buying the house buyer only have deposited some money and some currency as an asset. They can have some other one, but and the house seller has it an additional asset which is the house. Actually, you can see that here. And when to buy that house, the house buyer is going to towards a bank and to get a loan. And when they will get a loan, they will have a new asset in the form of a deposit in the bank account. And against that asset, and the house buyer will have a new loan to pay. So after making a transaction, buying the house, that new deposit will be transferred to the house seller. Yeah. And on the other hand, the house buyer will have the house as a new asset, but that against those that house, it has new loan, still that loan to repay. Now let's go towards the banks. Before issuing a loan, these are the balance sheet of a bank as explained them before. And now, or after issuing a loan, the buyer's bank will have a new loan as an asset. But at least that loan, it has created some money, borrowed money in the form of the deposit. And when the transaction actually happened here, the buyer's bank will transfer that deposit to the seller's bank. Yeah. And against the deposit, it also has to provide some reserves. And because that's a bond money in general form, we can think that. But for the new bank, for the opposite bank, because there we can literally think of them as separate two different banks. When the bank is different, they are actually going to transfer the real money against that deposit in the form of reserves, the base money. And here you can see that the reserves are now less. And against that reserves, they have just a new loan as an asset, but they have now little less reserves, the base money. This is actually a problem. How? Because you can think that if the transactions are going to be made in a lot of amount like these ones, there will be less reserves in the loan making banks because that reserves will be transferred to the people who will sell their houses, and that reserve will be transferred to their banks. If a bank is going to do issuing more and more loans like these and some other ones, they do so, they are going to become bankrupt in the form of the reserves. They will have less and less reserves, and if there will be demand against the real deposits, they have to tap the central bank's reserve facility. Maybe at that time, interest rate in the economy may be higher. The banks will have to get the money to give to the normal people who are going to tap for their deposits in the bank at a very high price, and that will be maybe not profitable, and the bank will maybe running at a loss. So that's a problem. And also it is going to affect the investor confidence into the bank because the share price of the bank is going to collapse. at a much higher rate. So that are some concerns bank has to keep in its mind before issuing the loans. So this is how central bank limits the creation of the bond money in the economy. It is through the incrementing the short-term interest rates. This is the rate at which the banks going to give the money additional reserves if the commercial banks want from the central bank. The monetary policy through interest rates is the ultimate limitation to the broad money creation. Like just as I explained earlier with the mortgage transaction, if there will be a housing boom through the additional mortgage transaction, if the bank just got its mind off, started making additional loans as much as without thinking too much about the risks, then there will be a housing boom in the market. More and more people are going to buy the houses. There will be more demand of the housing, and against that demand supply is limited kind of stuff. People are going to sell their houses at a higher and higher price. So there will be a housing boom that will cause the inflation in the economy. As so the central bank is going to make the short-term interest rates higher. And that will prove, and if there will be a bank on, and if there will be more demand of reserves, because in the mortgage transactions, as I explained, there will be a lot of demand of the reserves, the base money at a higher value amounts. So the banks which just made loans without thinking twice, without factoring any risks, they have to tap the central bank's reserve facility at a much higher rate. That is going to collapse the margins of the banks, and that is going to may make the banks bankrupt. So this is how the storage block on the broad money creation is implemented. And I can also explain the opposite scenario of this. So to sum up the whole concept, I'm going to explain this with an economic situation where there's little to no inflation. There's a kind of deflation scenario. There will be need of more money in the economy to stimulate the economy. So how this is going to happen? Actually, the central bank has target of making the inflation at 2%, keeping the inflation at the 2% rate. Not much more of that, not much less of that. So central bank will actually lower the interest rate, and that's ratio maybe 0.5%, which is the lower bound. After that, they cannot make it much more less. So what it actually going to do is it will create affordability between the banks to lose the additional chunk of profits against the competition. Yeah. What will happen here is that the banks are going to issue loans at a much lower rate now on. They have competitive advantage over other banks, and certainly all of the banks are going to do the same. Before lower interest rates by the central bank, the banks can only issue the loans at a higher rate, like 4% or 5% if the central bank has implemented the monetary policy of 2%, like so. If suddenly it drops to 0.5%, they can literally issue more loans at 3% or 2% also to gain more and more market share. So it will be easy for them to tap a central bank's reserve facility if they run out of the reserves. So the lending will become more competitive at low rates. People are going to choose more to borrow, and they are going to make their financial goals. They are going to make their businesses start. They are going to get more money from the banks. They are more confident in getting money at a lower rate. So more people will be able to finance their motives, and that will actually increase the lending in the economy, and that actually increase the money supply in the economy ultimately. That's how the real money multiplier works. That's not a fractional reserve banking. And this is the real world example which actually happens in the economy. So there are more complexities in the world right now about the banks and the money and the markets. And this is one of those concepts I wanted to share with you, which I think it will be beneficial for you to be learn the real world concepts rather than the fictional fractional reserve banking kind of things. I don't know how these YouTubers are getting themselves to do that. I hope so you'll like this video, and if you like this, then share it with your friends and family which are interested in the finance, fuel concepts, and the economy in general. Thank you for watching the video, and don't forget to subscribe to my channel. So bye.